The broadcast is now starting. All attendees are in listen-only mode.
All right, I think now you can hear me. This is our periodic Investors Observer members only workshop. I think I'm here. We had some technical issues, but should be good to go now. All right, so this is our agenda today. We're going to talk about charts. We'll talk about what else is happening, look at the sectors and industries that are hot right now, and then the rest of the session is for questions and answers from subscribers. Thank you to everybody who sent in one ahead of time. I can, as always, prepare slides and things like that if you send your questions in ahead of time. But if you have a question and you didn't send it in ahead of time, that is fine too. You can just put it in the question box and I will get to it as appropriate. All right, so let's look at some charts. We got 1 year of S&P 500 here. I added this line today, just sort of looking over the aftermath from January. We had some lows here that actually matched up with some lows from back here in October. But yeah, you can see we came down and then bounced pretty well so far. And I don't think this actually captures all of today's bounce just because I took the screenshot before the close. All right, one thing I did want to do is look at 3 years. I think looking at different time periods sometimes gives you a little bit different perspective on things. So here's 3 years of weekly candles. So you can see the difference in the sort of January dip here. It gets mostly consolidated in one really ugly weekly candle. Or maybe two if you include this week back here where we set the high right at the start of the year. But yeah, really the point of this is, I know January seemed bad, but unless you got in, right, like since October, you're still up. If you've been in the market for any length of time, you're still up by a lot, assuming you have a relatively well-diversified portfolio. So I feel like that's always important to keep in mind. 1 year of the NASDAQ. The NASDAQ's January was significantly uglier than the S&P's. This line is actually from this old high here back in April of last year. That's not a new one. That's just been on the chart for a while. So yeah, but again, still bounced. And the good news is if you look at the 3-year chart, you're up even more if you've been in the market for any length of time. And the low still only goes back to about June of last year. All right, the Russell is where things get interesting. The Russell went sideways for most of 2021. It had, well, tried to stage a breakout in November and then got pretty well clobbered in November and then again in January. I'd like to see it climb back into this range relatively soon, but we'll see here. Interesting, you're still doing pretty well in the Russell if you've been in for any length of time. I mean, 2021 was pretty much a wash, but if you got in even most of the time, sort of post-pandemic or pre-pandemic, still doing okay. All right, so here's 3 years of the S&P 500 versus the equal weight. We talk about the outperformance of the S&P 500 versus the equal weight. because those big five tech stocks at the top, your Apple, Google, Microsoft, etc. So that's up 68% compared to something closer to 50 for the equal weight. But even so, both of those are doing pretty well. But you can see, how the outperformance, it gets bigger in places and then it gets smaller and bigger, and then sort of stayed about the same during January, which is interesting. Growth versus value is another thing we look at. Here's a 3-year comparison instead of the normal 1 year. This one's interesting because all the selling in January, or the majority of it, was in the growth side, and the the value side didn't see nearly as much. Turns out over 3 years in this growth index, you've basically doubled your money, whereas you're up 40% in the value fund, which is still very, very good. But you can really see where in the market the selling was. It was in the growth stuff, the more speculative stuff in January. Apple versus Tesla, right? Like Apple is up 310% over the last 3 years, whereas Tesla is up, even after the drop it made at the end of last year, is up, we'll call that almost 1,400%, which is really just kind of a bananas number, but gives you an idea of how volatile these things can be, and what exactly, why it is that if you're going to buy something like Tesla and you're going to be up 1,400% in 3 years, you're going to have to deal with some months like January. All right, so that's all the comparison charts I put together. There wasn't really a whole lot. I just wanted to get that sort of longer perspective in there, and get some ideas about January. Sort of put that move in perspective. And it really was, I think this really tells the story here in terms of what was getting sold. It wasn't everything. It was really your more speculative stuff, for reasons we'll talk about in a minute. All right, so what else is going on? We still have the Fed and inflation as big drivers of stocks. I kind of think the consumer price index, probably to some degree the producer price index, the PCE report, and other inflation reports may start being more market moving than Jobs Day. Jobs Day has in past cycles been a big mover of markets, as that was kind of the thing the Fed was looking at in terms of setting and changing policy, whereas I think that it's pretty clear that the Fed is paying more attention to the inflation side than the employment side at this point. I also think the data is likely to be noisy for a while. Right, we still have COVID going on, which is, I think we know, going to affect the unemployment numbers when they come out next week, or sorry, not next week, on Friday. But there's a bunch of weather stuff going on too. Weather can affect the employment picture. Weather affects, right, like commodity prices in terms of how things get moved around. Energy prices, things like that. So all those sort of outside factors, that aren't just pure supply and demand dynamics, make it difficult to get sort of a clean report, which makes it really hard to know exactly what the inflation situation is at any given time. The other thing to remember is I think inflation isn't just a US story. Inflation is also running kind of hot in Europe and some Asian economies. Which is to say, like, this isn't necessarily the Fed's problem to fix. I've talked in the past about, how there isn't an interest rate that clears the problem at the ports. And so, yeah, right, like we need just more normalization across the global economy in terms of probably some increased services spending, but also, some of those shipping bottlenecks to clog, and just generally sort of increased goods production, right? We're seeing earnings reports this week and a couple of weeks before, and we'll have another week or two to go. And And one of the things we're looking at here is capital expenditures, right? Are companies spending money to increase the production of things? That's one way to solve a shortage, is you make more of the thing, which should help prices come down. We still do have COVID out there. The Omicron bulge seems to be on the wane in most areas. We'll see what's next. Hopefully nothing too serious. But it is still out there and it is a concern, and it is, I think, affecting the way people behave, which is really, kind of what an economy is. Earnings, like I said, going on, generally been pretty good. Been some compression of margins due to higher cost. One thing that's kind of interesting to note is that guidance, sort of as a concept, seems to be fading. A lot of companies stopped issuing guidance during the pandemic. Some of those have brought it back. Some of them have not, but a lot of companies seem to be shortening the length of time that they're guiding for. So a lot of them are doing like 1 quarter now, as opposed to, companies used to try to do like 1 or 2 year, revenue and EPS guidance, and we're not seeing a lot of that. We're seeing a lot of companies provide, a quarter or 2, maybe a full year. And I think some of that is just because, right, it's hard to know. And so, if you say, hey, it's hard to know, we're not going to give you a number, then the market doesn't punish you for being wrong when a bunch of unexpected things pop up. So it kind of makes sense, and hopefully it will maybe get rid of a little bit of the, sort of meet and miss earnings estimate game that everybody plays 4 times a year, which I think a lot of people think causes management to be a little bit short-sighted in terms of trying to hit quarterly numbers, as opposed to focus on really, providing the most long-term value. All right. So I want to talk a little bit about sort of interest rates and risk, and how it is that, right, like basically why that growth and value chart looks the way it does in January. So the Federal Reserve, right, as the interest rate setting body, controls essentially one rate. It's called the Fed funds rate, and it controls basically short-term, which is largely means overnight, unsecured borrowing between banks. So that's really the lever that they have. Other interest rates are derived from that rate, though, because if you think about, right, a 1-month loan is basically 31-day loans. Okay, that means that a 10-year loan is basically 121-month loans. So on some level, the rate on 10-year bonds is a reflection of what the market expects the overnight rate to be over the next 10 years, right? That doesn't mean they've plotted out 10 years worth of 1-day rates and tried to figure it out that way, but it probably reflects about an average. And so a couple things there. The reason the Fed is raising rates is because the economy is doing well, right? Inflation's a little hot because the economy is doing well. And so the Fed is trying to tamp down on that. So higher rates typically mean that, right, market is expecting the economy to do well. So one of the things that we've noticed over the last couple of weeks is, if you look at, say, the yield on 30-year treasuries, which is the long end of the yield curve, they've come down a little bit, whereas some of the shorter term stuff has gone up. The reason for that is, over the short term, it seems like rates are going to be higher, right? The Fed is going to raise rates in March, almost certainly. So you got to adjust for that if you're on the short term. Whereas if you're on the long term, say, okay, the Fed's going to start trying to rein in the economy now. That probably means growth won't be quite as hot somewhere down the line, or at least the cumulative growth won't be quite as much somewhere down the line. So the 30-year comes down a little bit. The curve kind of flattens out some because of that. But what that means for risk assets is, okay, when the Fed sets rates to 0, and you're an investor who wants some return on your assets in your basically your risk-free asset classes, your things like treasury bonds, bank deposits, right? Once those returns drop to zero, you have to kind of move into something riskier. So the first place you go there is something like high grade corporate bonds, right? Like lending money to Apple is almost as safe as lending money to the government. Well, so what happens when a bunch of people buy bonds is the yields go down. So that pushes, right, the people who had been satisfied with the risk and return on the high grade corporates into sort of your high yield corporates, which is what used to be called junk bonds. Right, that makes things like your safer stocks, your utilities, defensives, the other dividend players, that makes them more attractive. Those dividend yields go down as more people buy those stocks. And so you can kind of see how this search for yield and return pushes people, sort of successively out into riskier and riskier things. People get into the cyclical stocks. And then, at the far end, you get speculative assets, unprofitable tech stocks, some crypto we've seen, and a bunch of other assets. Okay, and so what raising rates does is it slows the economy down by making money more expensive. So obviously, if you have to borrow at a higher interest rate, it's pretty obvious how it is that that's more expensive. But on the equity side, if you think about, well, I'm a company that pays a dividend, if I want to sell more stock to raise cash, well, for every new share I sell, that's a new dividend I have to pay, right? So it gets a little bit more expensive that way, just in the sense of, right, as the prices for the dividend stocks go back down to account for basically all this money going in the other direction from what I was just talking about, your sort of dividend per dollar of share price goes back up, right? The yield starts to go back up. Cyclicals, you get a little bit of the same thing, but also, right, like price to earnings ratio, all of those things that you use to measure sort of how a stock is valued, as money comes out of those more speculative assets, those ratios come down, which means that for every dollar your company earns, right, or for every dollar your company earns, you have more share price, or less share price, right? So, right, like Tesla at the high, right, could issue a lot of stock for $1 of earnings, and now it's slightly less for every dollar of earnings because the earnings have stayed the same and the stock prices come down. So if they wanted to raise capital again, they'd have to sell more shares at the lower stock price. So essentially, it makes money more expensive, whether it's sort of on the debt end of the capital structure or the equity side. All right, so the things that are hot right now, energy finally made it up to the top of the list here, and this is based on our short-term technical score that I'll show you in a minute. Thermal coal, again, it's a weird industry just because it's relatively small, and a lot of it's international. Oil and gas, integrated, and exploration and production are the next two there. Real estate moved from number 1 to number 2 this time around, and it's residential REITs, which is exactly what it sounds like. That's housing. Industrial, a lot of that is like warehouse space. There's a New York Times article earlier this week, like late last week, about people buying up and just getting their hands on as much warehouse space as they can because of all these supply chain issues. People are trying to order as much stuff as they can, which means they're willing to deal with sort of some lumpiness in deliveries. And so what that means is, in addition to over ordering goods or supplies or whatever it is they're over ordering, they're also trying to reserve extra warehouse space, in addition to whatever their warehousing needs would normally be. If you're going to try to deal with a lumpy supply chain, one way to do that is to have more stuff kind of in stock or in a warehouse. You need more room for that. So that's what a lot of the industrial REITs are. And then retail. The retail mix is interesting. Some of the big mall REITs are not doing as well, but the strip malls, some other places like that are doing better. Financial services, I think this reflects a lot of earnings and also some interest rate stuff. Like financial services has always been on the list, but this is a different set of things than last time around when it was like, I forget what it was, but it wasn't regional banks and the big diversified banks, which are the top two here, and then reinsurance. And reinsurance is, I think, largely an interest rate play, even more so than the banks are there. Utilities, pretty steady here, almost always in fourth place. It's gas, electric, and independent power producers. Some of that may be based on the weather, especially the independent power producers. Those are basically sort of companies that operate a power plant that then sell electricity to the grid so that your electric company can buy it. So obviously, your Dominions and PG&E and AEP, depending on where you are in the country, that generate electricity, maintain a grid, and sell it directly to the consumer market. But there are some other companies that basically just operate power plants that are the sort of swing producers that ramp up and down as demand goes up and down. So you get a cold snap or something like that, everybody's heat runs a little bit more. You need more electricity. These guys step in those cases. And then industrials, but the industrials mix also changed this time around. Integrated freight and logistics, trucking, rental and leasing services, that's right, like that's the supply chain story right there. Like those are the industrial companies that are doing well. One interesting thing, let me go over to the website here and I'll show you where you can find this. So you go to the sector and industry tab here. I compiled this list from the short-term technical score, which is how things have been trading over the past month. You can obviously get this list based on any of the InvestorsObserver scores. The thing that I think is interesting here is this confectioner is actually the top industry. They're in consumer defensive, which tends to be, so consumer defensive is in 7th place as a sector, but confectioners, you got Mondelez. This company's pretty small, but then Hershey. Those are the big players in this space. And yeah, that's about, I think, earnings, maybe a little bit of dividends, but that I think that's what that is. But I found that interesting that a lot of these things that are up here are components of the top industries, whereas that confectioners at the top kind of stood out to me. A lot of it is just driven by Mondelez and some other stuff, but yeah. All right. To the questions, we got a couple of questions from, I think this is going to be Daniel, but I'm not 100% sure. All right, the first question was, can you better explain what a wash sale is? I understand it is if you take a loss on a stock and then repurchase the same stock 10 days later at a cheaper rate, that would be a wash sale. But what if you buy a stock, it takes a beating, instead of selling it, you just buy more, and it goes back up and you take a profit, or the stock, and then 10 days after that, the stock goes back down, you buy more again. Would that be a wash sale? So wash sale has sort of a couple of meanings. The most common, and the one that I think that he's talking about here, is selling for a loss and then buying back in within 30 days. And that is actually not illegal unless you're doing it for an improper tax benefit. Okay, so if you sell a stock so you can do some tax loss harvesting, and then you buy something that is, the term is substantially identical for the tax benefit, right? If you're trying to do that tax loss harvesting, but also buy back in within 30 days, you can't do that. Right? If you just sell it and then buy it again and don't try to claim it on your taxes, that should be fine. Your broker might flag it or something, but it's really not an issue unless you're trying to claim that tax benefit. This does not currently apply to cryptocurrencies. So you can do that sort of wash sale, right? Sell your Bitcoins, buy them right back, and do the tax loss harvesting in crypto. Now, there have been a bunch of proposed rule changes that would get rid of that, but as of now, it is okay. And the rule says you can't buy substantially identical securities. So selling a stock and then buying the same stock for that tax loss harvesting is definitely a no-no. Also doing something like selling your SPY, which is one S&P 500 index fund, and buying VOO, which is another S&P 500 index fund, that is also not allowed. But yeah, buying more of a stock when it's down is fine. Like that's what a lot of people call that sort of dollar cost averaging, right? Where you make a bunch of small purchases, either just over time or trying to hit dips. Either one of those is totally fine. The thing that makes the wash sale illegal is, right, selling it to record a loss for tax purposes and then buying back in. That's what makes a wash sale illegal. But there is another use of wash sale, which can be sort of trading between related parties, or in a lot of cases, right, essentially the same person. It's difficult in stocks, especially, large cap stocks, right? Like if you have two brokerage accounts and you enter a buy order for Apple in one and a sell order for Apple in the other, the chances of, right, like you're not really trading with yourself there. But in, the sort of penny stock space, and a lot of this happens in the crypto space, particularly some of these like high dollar NFT transactions where it's like, oh, a cartoon picture of a monkey just sold for $5 million. It turns out in a lot of cases that is a related party transaction where somebody basically moves that monkey from one of their wallets to another wallet that's owned by the same person. You say you bought it for $5 million, but you bought it for yourself from yourself, so you didn't really buy it for $5 million, but now you can say, hey, this asset last traded for $5 million, which, yeah, is all very silly. It is illegal to do it in the penny stock space. I don't think regulators have gotten to the point of caring about the cartoon pictures of monkeys and other NFTs yet. So you're allowed to kind of pump those in that way as much as you want. But that is another thing that people sometimes when you hear the term wash sale, they're talking about that as opposed to this this sort of tax loss harvesting business. All right, so the same person said that they received the notice saying their account would be suspended for 90 days if their most recent stock sale settled before two other sales. This is because I may not have enough money in my account to cover. If a sale hasn't settled, why is the money in my account after selling a stock? What he's trying to ask is, how do you know when a sale is settled or not? So this is a problem that typically only occurs in cash accounts. If you have a margin account or something like that, like unless you're just absolutely maxed out, you shouldn't really get these sort of warnings. So that can be like an IRA or some other tax advantage account, or just a regular brokerage account that doesn't have margin trading available. So settlement time in the US is what's known as T+2, which means essentially the trade date plus 2 business days. If you buy a stock today, which is the 2nd, that trade settles on the 4th. So what these warnings are is you're supposed to have settled cash in your account to cover purchases on the settlement date. So if you think about what does T+2 mean? If I buy a stock today, the stock hits my account on the 4th, right? That's why you have to, right? There's the ex-dividend date, which is different than the record date. If you look at dividends, right? They give you a record date, and then the ex-dividend date is always just 2 days before that. What that means is you have to buy the stock sort of those 2 days before so that you're a shareholder of record on the record date. But it also means that if you sell a stock today, the cash from that sale doesn't hit your account until the 4th. And so you're supposed to have settled cash in your account to cover purchases on the settlement date. So there's 3 basic violations of these sort of rules, and I don't know exactly which one this person ran afoul of, but they are basically sort of what they call a good faith violation, which is selling a security before that purchase is fully funded. So if you buy a bunch of stock on Monday morning or if you sell a stock Monday morning, use those funds to buy stock B on Monday afternoon, and then sell stock B on Tuesday before the cash from the sale of stock A on Monday morning has hit your account, that's a good faith violation, right? You've essentially traded using money you don't have. Free riding is, so you buy a stock, you put in order to buy a stock that you can't afford on Monday, right? You're supposed to have settled it cash in your account by the settlement date. So that would give you until Wednesday. But you sell the stock on Thursday. So you didn't have the cash, you blew past the Wednesday date, and then you sell it Thursday for a gain. And right, just say to your broker, here's the money I owe you for that stock you bought. What you've essentially done is take a loan that the broker didn't consent to lending. They don't care for that much, it turns out. And then there are what's known as cash liquidation violations. So that would be buy a stock on Monday and then sell some other holding on Tuesday to pay for the purchase of the stock you bought Monday. That's also not allowed. You're supposed to have free settled cash in your account at the settlement date. So yeah, I'm not sure what exactly happened here, but you ran afoul of one of these if you're getting that sort of notice. And yeah, you can having a margin account will solve that. But yeah, margin isn't available in IRA and some of the other tax advantage accounts. So without more information, I can't really tell you exactly what's going on there. All right, so then we got this other question from Richard. He said he did a few vertical spreads that have gone deep in the money pretty quickly. Is it better to wait and let the time expire when the underlying price is above or below the sold leg? So for something this short term, the stock price's proximity to one leg or the other can have a bigger effect than time. Which is to say, if you're doing a vertical spread, right, you have a sold leg and a bought leg. So if the stock price is very close to the bought leg, you'll get a little bit more extrinsic value there than is in the sold leg. And so when you go to unwind the trade and you sell the option you bought initially and buy back the one that you sold, the extrinsic value is working in your favor a little bit there. As it gets deeper and deeper in the money, obviously that's less true. Obviously, as you have less and less time, that gets to be less true as well. So really, unless you think it's very likely that the stock is going to recover, it works out better to try to close it early because of that effect. And the thing to remember is, especially things that move very quickly and suddenly, right? Like if it's just a volatile stock, this happens a little bit less. But if it's a relatively less volatile stock that where suddenly volatility in that particular name or market wide goes up, you'll see spreads get real wide, and sometimes the pricing can be pretty unfavorable. And so what you want to do is you don't want to pay, because you will have to pay for these credit spreads to close them. You don't want to pay more than the difference in strike prices. So if you sold a 30 put and bought a 25 put, that's a $5 strike width. You don't want to pay more than $5. The most you can lose there is that $5 per share. So, sometimes the market will give you a price of $6, but in that case, it's fine to just let the options be exercised and assigned. Exercised and assigned, unless you have some outrageous exercise and assignment fees, which most of those have gone away at this point. But yeah, there's no reason to pay $6 for $5 worth of options to close a losing position. So that's the other thing to keep in mind. So what I would do is put in some sort of limit order to try to for less than that spread and see what you can get. Yeah. All right, that was all the questions that got submitted ahead of time. Thank you as always to people who send those in. Let's see what else we got here. Is sector versus stock investing the safer route in this roller coaster market environment? That's from Rob. So Rob, the reason that I show this sector thing is less to say, oh, hey, you should buy the energy sector. Then, I mean, the sector is just a bunch of stocks that all do related things, right? So as economic and market cycles happen, right, some things go up and some things go down. So really, right, I mean, the confectioners industry is probably a good example here. Mondelez is a, large cap stock that's done pretty well. Hershey's is pretty big, not as big as Mondelez. Tootsie Roll and Rocky Mountain Chocolate are very small. There's probably some ETF that tracks the confectioners industry. But yeah, Mondelez is the snack business of what used to be Kraft Foods. Right, it's a giant global corporation. So really this is another way to look for stocks is really the intention here. Certainly, there are absolutely sector ETFs that you can try to trade in and out of and watch the sort of thing. But this is another way to drill into finding stocks, right? So here's the top stocks in the energy sector. And if you wanted to see the thermal coal ones, you can do it this way. I don't know that necessarily sectors are generally less volatile than individual stocks, right? Just because if you average a bunch of things together, they'll typically move a little bit less than any one of those things. So it might be a little bit safer in that regard. But really, if you want to be in stocks and you don't want to deal with a bunch of single stock volatility, something like an index fund is probably the way to go there. And you still took a loss in January as far as that goes, but it was, depends on the index, but it's less than if you had been, really heavy some particular names here or there. All right, so here's an interesting question. The question here says there's a covered call with a strike at 67.50 at the January 2023 expiration. The option price was 240, and now the stock is at 80 though, so the option's well in the money. And the option is at 14.8. Should you roll over or wait for the buyer to execute? So without knowing what the stock is, it's difficult to say, but one thing that I will tell you is, unless the stock pays a dividend, the buyer won't execute. Early assignment of options is pretty rare. So one thing I will say is you should do is consider the extrinsic value in the option. So if the stock is right at 80 and the strike is 67.5, the option is, right, you got $12, right? The strike price is $12.50 in the money. So if the price is 14.8, take off 12.5, the option, you bought it for, or you sold it for 2.4, and now the extrinsic value is 2.3. You could roll it here. You're basically up a dime, right? You do have to put in more cash, but you're basically up a dime there. It doesn't really seem to be worth rolling it from that perspective, unless you're, I mean, depending on what you're trying to do here, but you haven't really gained anything in terms of, your short time value in this trade, and not very much time has gone off, and the option, it turns out, isn't really far enough in the money for you to have had any time value roll off. So you could roll it, but I'm not sure why you would necessarily. All right, so Charles wants to know, why have there been so few managed option trades lately? Yeah, the reason is, we do generally try to do around 4 trades per month in each of the 3 portfolios. But we haven't felt like we had a good handle on the market recently, and we would rather do no trades than put out trades that we didn't feel good about in the portfolio, and that is why. I'd like to think, with hopefully coronavirus on the way out, we'll get some more normal times and we can start putting out some more trades. It's certainly, we're certainly still spending time. We're just not finding trades that we feel good about publishing. And I feel like the reason you want trades in the portfolios is to make money, not because you want 4 trades a month. Right? Like, you can close your eyes and pick 4 losers every month. That's right. You don't need to pay me for that. So the reason you subscribe to Investors Observer is for winners. And so, we would rather not publish a trade we didn't feel good about than, just publish some trades to hit a target. So that's why we're still spending time on it. We're still looking at it. I hope to have more soon. The Blackstone trade we closed earlier today. That worked out nicely in our favor. Hopefully we'll find some other stuff, fairly soon. All right, so I have a question about Matterport. All right, that is a fun chart. So this kind of thing is a little hard to evaluate, because what I would like from a company description is some clear idea of what the product is and who the customers are. And I don't really get that here. What I gather is they make 3D maps of physical spaces. Certainly you can use that for, say, remodeling or something like that. There's probably a bunch of things you could use it for. I don't know who the customers are here or exactly what the product is, which makes it a little hard to put it in any sort of like macroeconomic context. But yeah, I could tell you the company doesn't make any money, which has been not a great spot to be in terms of, tech stocks that don't make money did real bad over the last month or so of 2021. And then, I've said a couple times during this presentation, that was where a lot of the selling was in January as well. And so, it seems like Wall Street still likes the stock. They've got a much higher price target on it. Much higher than the current price. This target is lower than where it was in November. So the thing about markets is they're sort of efficient over time, right? No individual price is necessarily the correct price. So is this price too high? Probably. Is this price too low? Maybe. So, especially after a big drop like we had in January, it's worth thinking it might come back a little bit. I wouldn't expect it to be back in the 30s anytime soon. But yeah, it's hard to tell with this kind of speculative thing where you really don't know what the company does or anything. And my guess, just based on the chart, is a lot of this rally was based on people talking about the metaverse and things like that, which is largely vaporware at this point. Which is to say, it's a lot of promise and basically no delivery. So it's hard to hard to put a price on that, just because you don't know, right? Like, what is the product? Right, the metaverse product hasn't actually been made yet, so you don't know what the product is, or the costs, or the business model, or any of that. All right, that is it. We don't seem to have any more questions coming in. This session was recorded. We'll send out a link to the recording and post it on the website tomorrow. Thank all of you who stuck around through our rather lengthy technical difficulties at the beginning. Of the session. Yeah, all right, we got one more question here. Let me look at this. So the question is, why is this stock bouncing around so much when it is rated a strong buy? Yeah, I mean, generally tech stocks are pretty volatile, more so than some other things. Again, this company is, unprofitable over the last 12 months. It's still rated a strong buy, which means analysts still like it. But yeah, it's relatively new in the sense of only having been around since about the middle of 2019, it looks like. It's unprofitable. Those kinds of things are going to be volatile. Let's see. Anything particularly alarming in the recent news? But yeah, unprofitable tech stuff was the recipient of most of the selling to end 2021 and into January, and this stock falls in that bunch. Sometimes the good stocks go down with the bad. If you want to see previous recordings, you can go to the news section of the website, and then under personal finance, they're all right there. Yeah. All right. Thank you for coming. Thank you for sticking with me. Thank you for subscribing to Investors Observer. We'll send that email out with the workshop. We'll send that email out tomorrow, and the next workshop will be in 3 weeks. All right. Finally, just got a comment from RP about the Facebook Meta earnings report. I haven't seen it because I've been doing this. I'm not. Yeah. So yeah, I can't really say anything about it other than just I haven't seen it. But yeah, thank you for coming. Thank you for subscribing, and I will talk to you in 3 weeks.